For some insights on what the options might be saying about equities, volatility, let's bring in Amy Wu Silverman, head of derivative strategy at RBC Capital Markets. And, really people should watch all the time. And hopefully they were watching. You were on about a month ago. And at the time you pointed out that in previous rallies during the year, you didn't see hedging increase.
Right.
But a month ago you said the VIX was still quiet after that spike. But about a month ago, you said you are starting to see quite a bit of hedging, and now it's continuing. Nothing's happened in the past month, though, that to indicate that all that angst among traders was justified. You still think that something could happen because is it even increased the hedging?
It's even increased, Joe, and the way I think about it is the market is sort of lying awake at night and wondering what bad things could happen. I say that because that demand in hedging has not only picked up more, you see it in these secondary metrics that I appreciate most people don't watch all the time. We do. But not the VIX itself, but the volatility of the VIX has picked up.
The VVIX.
The VVIX, the vol of vol, has picked up substantially. Yeah, I know. It makes your brain hurt for a little bit. But look, it's the idea that these tails in the market, these kind of 3 standard deviation drawdown scenarios, we're very much seeing money being put into these. So obviously, we have earnings coming up. Obviously, we have U.S. elections, and the worry continues to rise. And that, again, is a very different narrative from the first 6 months of this year.
I think last time you were on, there were some straddles that were getting expensive. So is the hedging only on the downside, or is the hedging, it's only on the downside? You're not hedging against like a major melt-up? No,
not on the S&P 500. Now, that's not true for China. We're seeing all the upside hedging actually in the China-related ETFs. Obviously, Beijing had that stimulus come out, and investors are, really feeling that MOMO and FOMO there. All these ETFs that are related to China, so an FXI, ASHR, KWEB, EEM. These are all plays related to stimulus, and we've seen historic call buying there, but almost none related to the S&P. The bet there is much more for limited upside. The
October lows that we've hit so many times in the past usually come after a weak September, though. It almost seems too late for an extend itself unless it was really sharp. Do you think something like that is possible, like a real fast drawdown between now and the teens of the Ides of October?
Look, when you look back to the seasonal playbook, you would say the drawdown in October, the pickup in volatility is usually there. You go back 20 years. That's what we see, right? But again, like you said, that's after a weak September, too. Now, how does that play into it? I think things are going to drag out a little bit because obviously, usually in November, we actually see the market do okay, but we have fairly large catalysts this time that we don't have all the time, right? We only have it every 4 years. And so I think that kind of shift things a bit later. And obviously earnings. Usually you get a tick up in volatility the first 2 weeks of earnings because that's the first time you get all these kind of idiosyncratic pieces of news flow, and you get a tick up for volatility because of that, too.
Trying to plug in some fundamental scenarios that could explain. Let's say we're a month delayed here and the big sell-off is in November. I don't know which election outcome could cause that. Maybe a wave on either side. Maybe, depending on your viewpoint, some people would think that a Harris presidency would be bad for business. Other people could think that the going back into the chaotic environment of a Trump presidency could cause a sell-off in the market. There's something for everyone in why you could see November being weak, isn't there?
There's something for everyone. I'll tell you, when I talk to investors, a lot of what they say is just they need this to be over. There are all these Trump baskets. There are all these Harris baskets. There are all these international plays. They've got both playbooks ready. But because the election is now much closer than it was when it was Biden versus Trump, no one's been able to deploy their playbooks. I think that's one reason you're seeing that volatility leading in relatively expensive.
But don't you think part of the issue is that if you have Republicans who are going to own the Senate, and if you have Dems owning the House, it almost doesn't matter what really, I don't want to say it doesn't matter what happens, but from a market perspective, people will say, okay, gridlock is good. Yeah. We're good for that. If you think that Trump wins the presidency and therefore somehow Trump helps the Republicans take the House and the Senate, whole different game.
Yep.
Right? Unlikely if Harris wins the presidency that all of a sudden the Dems take the Senate too. So there's sort of the outcomes are actually, in an odd way, very different potentially.
They're very different, and I do think a lot of times for investors they fixate on this presidential win, and the reality is it's like, what is the picture of Congress? That actually matters much more. I'll tell you one scenario that investors are talking about. So, for instance, let's say Trump does win. A lot of his rhetoric on NATO has European investors we've spoken to concerned. So one of the larger international plays is just simply U.S. outperformance versus European outperformance. Do we see fund flow shift because of that? So again, it's not necessarily these nitty-gritties. It's these broader changes that people are worried about in terms of positioning.
All right. I don't... it's possible nothing happens. And there's so much liquidity. We're in an easing cycle. How much is in money markets ready to come in here? There's been a lot of stimulus. There's still stimulus. We haven't spent any of the things
Larry Fink was saying yesterday the economy is not going into a soft landing. It's not landing. He said it's still growing 2 to 3%.
I saw that as well.
So if that's the case, along with the easing cycle.
Look, one thing I'll tell you is one of the most popular trades, and it continues to be really a substantially popular trade in our market, is simply continuing to sell volatility. And that's with volatility on the upside, not really that expensive to begin with. But when you look at the growth in notional value of all these funds that are selling volatility, collect further yield, it kind of tells you two things. One, there is still a group of people who don't think much will happen. But also, two, that there's also not that much upside left. And that's why they're trying to yield scrape these options in the near future.